My name is Perry Jeffries III, known affectionately to our community as the financial strategist. And what we do is we help individuals. Those individuals are high income earners, entrepreneurs, and real estate investors. Put together systems to allow them to become work option in 12 to 36 months. I'm the founder of Cash Flow Unlock and also the president of Diamond Equity Advisors, a investment advisory firm located here in Columbus, Ohio, with clients across the country. Here to rock and roll with you. I love that question. So first and foremost, infinite banking, the IBC infinite banking concept is not an account. Infinite banking concept is a strategy. It's a strategy where you are using cash value life insurance to become your own bank. And let me keep it 1000%. This is not what Perry made up. This concept was first brought to light by R. Nelson Nash in his book, Become Your Own Bank, right? Become Your Own Banker. So highly recommend you get that book. But in short, the concept is where instead of storing your money in a savings account earning less than 1%, at that, you're now storing your monies in a cash value life insurance policy, but not just any type of cash value life insurance policy. A properly structured, optimally funded, high early cash value policy with a mutual company, so that as you store money in the cash value policy, you don't have to wait 2, 3, 4, 5, 6 years for you to have cash value. You have cash value immediately, because this is now where you're storing your cash. Now, you ask the question like, why are wealthy people doing it? Well, wealthy people are doing it because guess who else does it? The banks do it. If you go research and go ask your banker today, hey banker, where do you keep your money? Right? Where does the bank keep your money? Guess what? They don't keep it in that sorry savings account or checking account that they sell to us. If you go research it, banks currently have right now around $218 billion stored in cash value policies, but they don't call it infinite banking. They call it bank-owned life insurance. So you may ask the question like, okay, why in the world are the banks doing this? Because the banks are required to have what they call tier 1 capital. That's money they can't afford to lose, that they have to keep on their books. Well, what better way to store that capital than into a policy where they're getting uninterrupted growth, a guaranteed dividend. They can access money when they need to in the form of policy loans and unstructured loans that they're not required to pay back, so it doesn't affect their debt to income ratio or their cash flow. And in addition to that, when the policy matures, when the person who has ever liked to have the policy on dies, they then get that money tax free, right? So let that sink in for a second. The banks are storing their cash in a place where they can grow their money tax deferred. They get access to money via tax free with a policy loan. And when the person passes away, say the CEO, they get millions of dollars tax free to then run it all the way back again. So that's what we teach, and that's why we love the infinite banking concept. So it's not a new concept. We've seen the Rockefellers do it. We've seen many banks do it. And again, you can always, I tell people all the time, trust but verify. You can listen to this information and get awareness, but still go do your own research, and you will be mind blown by how much money the banks currently have in cash value life insurance, but not the standard stuff, that Dave Ramsey talks about or Susie Orman talks about when they say, oh, cash value is a bad deal. We're talking about cash value policies that are structured in such a way that for every dollar you put in, anywhere between 75 to 90 cents goes towards your cash value. That's what's super dope, and that's why wealthy people use it, because it's the same strategies that the banks use to get multiple benefits out of the same dollar. Such a good question. So when we say you should think like the bank, what we're talking about is this. Think about how the banks make their money. The banks aren't making their money on saving and one day hopefully having cash available in the future. So right, they're not using an accumulation theory. That's what we've been taught to do as consumers, right? Hey, work really hard. Hey, put some money away into your 401k, and then one day, hopefully, prayerfully, you'll have a large enough nest egg to retire at age 65. The banks don't work that way. What they do is they engineer cash flow today. Every play they make is to create cash flow at this very moment, right? So they're creating cash flow while we're being taught to save and wait for some time in the future. What if you start to think like the bank and start to create cash flow today? If you create a cash flow today, and let's say enough cash flow that covered your living expenses, you effectively become work optional. And what we have found time and time again is that it's way easier, not easier, but way easier to become work optional than it is for retirement. And if you kind of wonder why, hey Perry, why do you say that? Well, let's just look at some math here real quickly. If someone wanted to have $5,000 a month in income during retirement, that's $60,000 a year. How much would they have to have stored in a 401k or an investment account? Well, if we use the rule of 5%, they would need $1.2 million, right? So how long would it take them to save or make the right investments to accumulate $1.2 million? In that same vein, how quickly could you create $5,000 a month in cash flow coming from these four pillars? Real estate, entrepreneurship, infopreneurship, and also too, still using your traditional, non-traditional investments like stocks and cryptocurrency and things of that nature. Which one will be easier to create $5,000 a month in cash flow coming in from these assets, or saving and hoping you have $1.2 million in the future? That's what we mean by starting to think like the bank. And in addition to that, we've been taught as consumers that all debt is bad. Let me let you in on a secret. If you are currently putting money into a checking or a savings account, did you know that you are currently a private money lender? Yeah, you lend your money out, and you provide short-term loans to the bank. Have you ever wondered why the bank is paying you interest? You think they're paying you interest because you're a cool cat, right? You know what I'm saying? Because you dress fly? No, they're paying you interest because you're actually lending them money. So if borrowing money was so bad, then why do the banks make a living off of borrowing money at 1, 2, 3% and then turning right around and lending it back to us at 6, 7%? If you look at that, that is probably one of the most phenomenal business models ever created. Hey, I'm going to borrow your money at 1%, and then when you walk out the door and come back and need money, I'm going to lend it to you at 6 or 7. And Lord, don't let it be a credit card. Now it's 18 to 30%. They make their money in the margins. So when we say think like the bank, ultimately what we're saying is you want to solve for cash flow, not for future accumulation in the future. Because cash flow today will free you up today versus waiting for what may or may not come in the future. That's the start of thinking like a bank. So more times than not, people know that real estate is the cheat code, right? Real estate is the one investment that gives you what we call the trifecta. One, it gives you tax benefits. So whether you have a W-2 job or you're self-employed, owning real estate will help you save on taxes. Just a fact. Number two, real estate typically appreciates, right? So over long periods of time, very similar to the stock market, real estate is going to grow in value. So real estate can actually help you grow your net worth. And three, depending on how you're using the real estate, it can provide cash flow, right? So when you look at that trifecta, why wouldn't you be looking to invest and acquire real estate, right? So that being said, think about it along those lines. What the barrier that stops a lot of people from investing in real estate is access to capital. And more times than not, it's not that they don't have the money, it's just they don't want to risk the money, right? It's like, man, I got $20,000 in my account and I'd like to start investing in real estate, but that's my emergency fund or that's my retirement account and I can't afford to lose it. So effectively, they're trying to hold on to that money. Well, with the infinite banking concept, when we learn it, we learn that that same dollar can be used multiple times. So what we can do, instead of storing our money in savings accounts, we can store our money in these policies. Then when we come across a real estate deal, we can access our money via a policy loan from our life insurance. So our money continues to grow uninterrupted inside the life insurance, right? And we get access to capital via the policy loan, which is tax-free, right? Then we can use that policy loan as the down payment or the seed capital to invest in real estate. So we literally closed on another property today. My wife now has acquired close to $2 million in real estate over the last year and a half, 2 years, and we've yet to use any of our own money. Because again, we're thinking like the bank, right? We're thinking about how can we leverage other people's money, where can we store our cash or get access to capital, and how can we acquire these assets and control $2 million worth of real estate with only using, a fraction of our own assets, right? That right there is the cheat code. So that's how we've been able to acquire property as fast as we have, because we have acquired the properties. Down payment is using the infinite banking concept or another leverage tool that we have within our grasp. And then from there, we acquire the properties, rehab the properties, rent the properties out using the Bird method, refinance, and pull our cash back out, and rinse and repeat and do it again. That's how we've been doing it. So, great question. That idea of, okay, should I try to get a lot of life insurance? So, you have to have this paradigm shift with your understanding of life insurance. You're not looking for a high death benefit. You're looking for the most cash value you can get. The death benefit is just a value add. It's just kind of the cherry on top of the cheesecake. You ordered the cheesecake, you didn't order the cherry. That's the death benefit. So the death benefit is what pays out when you die. That's not how you think about the infinite banking concept. The infinite banking concept doesn't start with, I want this much life insurance. It starts with, I have this much cash available to fund a policy. So you actually fund a policy based upon the cash you have sitting on the sidelines or sitting in a savings account, and also to the discretionary cash that you have available after your bills are paid. So everybody's policy is structured and customized based upon their current cash position and cash flow position, right? So this is not let me go get $1 million policy. The conversation is more like this. Hey, so how much do you have currently sitting in your savings account? Okay, you got 20,000 sitting in your savings account. Okay, how many months of emergency fund is that for? Oh, that's 6 months. Okay, great, cool. So what if we leave 3 months in the savings account for true emergency? Then we take that other 3 months and we use that to front load a policy that's built around the infinite banking concept. And oh yeah, by the way, it is an insurance policy, which means you have to commit to continue to put premiums in based on your current cash flow, right? Your net income, I should say, based on, hey, this is how much income I'm making. This is my monthly expenses. If it's what I have left over, how much of that can be used to fund the policy? That's how you build and customize a policy. It's not about, let me get the highest death benefit. It's about, what is my current cash position? That's why infinite banking concept is a strategy. Right now, we have 11 policies. And those policies range from term policies to whole life policies, and sometimes index universal life policies, right? Because they're all part of a system. And as we make more money, as we refinance and cash out of more real estate deals, as our income goes up with our businesses, we now have access to more cash. So every time we get access to additional cash, we're looking for a place to store that cash. And where we're not going to store it is in a savings account, paying less than 1%, less than 2%, less than 3%, and being taxed on it, when I could store it in another vehicle where I can get a better, where I can actually not even better, get a dividend versus an interest rate. That's a whole nother conversation. Matter of fact, we'll jump into that super quick. Side note, would you rather earn interest or be paid a dividend? But what's the difference? Interest is what you receive for lending money. Dividend is what you receive for ownership. When you're in a properly structured policy that has been funded and optimized for your cash flow with a mutual company that's set up for a high early cash value and solving for the lowest death benefit, you receive a dividend, which means the insurance company is paying you as an owner of the company. Would you rather get paid as an owner or get paid as a lender? That's the question you have to ask for yourself. But that's things that we consider when we're setting up a policy. So something that we teach in our Think Like the Bank challenge, and if you're interested, make sure you go to cashflowunlock.com. Make sure you get onto the waiting list for the next upcoming challenge. One of the concepts we teach is leverage, right? What we've found, and did a lot of research on this and a lot of case study on myself, is how can I use the same dollar multiple times? Well, there are certain asset classes that you can put money into where you can leave your money there, let it continue to grow, not have to sell it, not have to cash it out, not have a taxable event, and be able to get access to capital, right? You can do this with, let's start off with real estate since we're talking about it. If you have equity in your home, you go sell your home so you can buy another piece of real estate, or you can get a home equity line of credit and use that line of credit to acquire the real estate. So now you have two pieces of real estate versus one with no taxable event. Same way with your 401k. You know, I just get to cringe, as the young folks would say, when I see people blowing out of their 401ks and paying taxes and penalties and that sort. Did you know that you can usually borrow from your 401k in the form of a true 401k loan? So I'm not talking about a hardship. I'm talking about a true 401k loan where you can borrow up to 50% of your 401k to a max of $50,000, and the principal and interest payment goes back to you. You now became the bank of you, just like that. You didn't have to sell your retirement, didn't have to pay taxes, you didn't have to pay penalties. You can do the same with a brokerage account. We help clients establish security-based lines of credit where they can keep their stock account currently growing, uninterrupted, not having to sell anything, never having to liquidate, and get a line of credit. And you have, obviously, the cash value policy properly structured. You can jump in there and use that. So now, again, your money's growing uninterrupted, earning a guaranteed rate of return inside that policy. And when you need access to capital, you can access it via a policy loan, which is an unstructured loan. What does unstructured mean? It means you don't have a required monthly payment, which means you have the flexibility to pay that loan back in your own time frame at your discretion. When you get these concepts down, you start to realize, like, I have access to way more capital than I ever thought I had. That's how we've been able to move like this. That's how we've been able to move as quickly as we have and as efficiently as we have, because we have not had to sell any of our own investments. We have not had to make this decision of, should I sell this or keep this? No, I'm going to keep this and get access to capital and go acquire these assets that help us become work option. We've been conditioned to, hey, we need to save, we need to pay off debt, and then we need to put money away for a proverbial nest egg that's going to be available to us at 59 and a half or 65 when we go to retire, right? But when you look at some of the wealthiest families in the world, and I've actually done this, and I highly recommend that you do this as well, go meet with some of the most successful people you know. Go meet with some of the people that you see who have true financial freedom, right? And ask them, hey, where do you invest? I did this for about a year and scheduled lunch meetings and Zoom calls, and every time I spoke to an individual, not one of them said, yeah, Perry, I saved my way to financial freedom. Or I saved my way to become worth $100 million. Or I saved my way to acquire 100 properties, right? Every one was, we invest in real estate, we invest in privately held businesses, we don't store our money in a savings account, we invest, we put our money into insurance policies, right? It was a reoccurring thing. So when you start having this reoccurring thing and start hearing it, it's like, hold on, is every dog barking up the same tree? Does that make the tree the right tree? Absolutely not. Because if that was the case, every person we know making six figures would be financially independent, but they're not. Why aren't they? Well, it comes down to, what is their wealth creation system? What is their financial freedom strategy? Are they saving for one day, or are they creating cash flow today? And the individuals that I found who are killing it are the ones who figured out and made a decision, now I'm going to create cash flow today. Which leads into what I really love about that question. It kind of leads into, how do you define wealth? And how we define wealth, the definition we've landed on, is wealth is a system of ownership that provides predictable cash flow. Let me say that again. Wealth is a system of ownership that provides predictable cash flow. A system. A system allows ordinary people to achieve extraordinary results. excuse me, the way I like to say it is a system is a recipe. I don't know how to bake a cake. My wife is a phenomenal baker, but she has a recipe. So I could go, I feel 100% confident that I could go into her recipe box, pull out the recipe on how to make a pound cake, and produce a pound cake that is at least edible. May not be as good as hers, because she got the magic touch. That's why she's married. But I could probably produce a pound cake that we all can sit down and enjoy. So a system is a recipe, and a system of ownership. In order to create wealth, you're going to have to own something. You're going to have to own some real estate. You're going to have to own a business. You're going to have to own your intellectual property where you can turn your knowledge into cash flow, or you're going to have to own, some paper assets like stocks and cryptocurrency and things of that nature. But just don't get it twisted. You're going to have to own something in these four. With that system of ownership, when those assets start to produce cash flow, that's when you become work optional. That's when you become financially independent. When you can wake up and know that, hey, my monthly expenses are say $5,000 a month, and I have $6,000 a month coming in cash flow from assets, not from my income, from my assets. That's when work becomes optional. You can choose whether or not you want to continue to trade your time for money or not. Super important that you get that nailed down. And the last piece I would add to that, when do you know you're wealthy? When you're wealthy, you're going to experience three things. And I'm going to say these slowly because I want to make sure that these hit home. The first thing you're going to experience is security. What I mean by security, if you're married, you have a spouse, you have a partner, you have children, right? Or even if you just by yourself and you need to look in the mirror and ask this question. Look in the mirror and ask yourself this question, or ask your spouse this question. Do you feel safe in our current financial situation? If there's hesitation, it's not a resounding yes. That means you haven't created wealth. Because when you have true wealth, that equates to security and safety. Number two, you have time freedom. If you have to ask someone permission to do something, you don't have any wealth. You have to ask permission to go on vacation. You have to ask permission to take care of a sick kid at home. If you have to ask permission to, not work with clients for the next 30, 60, 90 days, if you have to ask anyone permission, that means you don't control your calendar. Now, if you're like me, you got kids in sports and AAU, maybe I'm not wealthy because they control my calendar right now, right? But the point is, that's something I choose to do, right? So if you have to ask anyone permission to manage your calendar, what you can do in your calendar, then you don't have an experience wealth. So time freedom, number two. Number three is abundance. And when we say abundance, simply meaning this. You have more than enough to cover your needs and your wants. And you have extra to be a blessing to somebody else. That is true abundance. Abundance doesn't necessarily mean that you have a house paved with no silver and gold. It simply means I can cover my monthly nut, I can do the things that we want to do, and on yet by the way, I'm in a position where I can be a blessing to somebody else. So wealth, the definition of wealth is a system of ownership that provides predictable cash flow. And the symptoms of being wealthy is safety and security, peace of mind, time freedom, never having to ask permission. And three, abundance. Being in a place where you can be a blessing to someone else without a fraction what you currently have going. The biggest mindset shift is your identity, right? How you identify. I've worked with numerous coaches here recently, understanding the subconscious, understanding the nervous system, understanding just how your body, responds. The neuro-linguistics, something I just heard learned here recently, is kind of like the words that you use and how it triggers your mind. And what it all comes down to, in order for you to start to manage your money like the bank, you have to spend the time, the groundwork, and changing your identity. Many of us have heard this, or maybe you haven't heard it, but I've heard many of coaches talk about the concept of be, do, have. Right? So you first have to be the person that you want to be in the future. And then you'll start to do the things that person in the future does. And then you start to have the thing that the person in the future has. we've been conditioned and taught that it's have, be, do. Or when I have enough money, then I'll do the things that I want to do, and then I'll be the person I want to be. We actually want to flip that order. So it first starts with an identity shift. Are you the lender or the borrower, right? Are you a owner or a consumer, right? Let that sink in for a second. If I was to ask you this question, hey, are you an owner or a consumer? If you're just taking your seed, which is your money, and you're consuming that seed and you're eating that seed, you're a consumer. But if you're an owner, you're taking that seed and creating more seed, right? So that is the identity shift that has to happen. So when we say you have to start to think like the bank, it first starts with having an identity shift, becoming a different version of yourself, and truly believing that you deserve the things that you're looking forward to. Yeah. So a couple of components, and I learned this from, I always like to pay homage to, the experts that I've learned these things from. I learned this from Gary Gunderson. I highly recommend you get his book, What Would the Rockefellers Do? And also this other book, Killing Sacred Cows. And the way he explains it is this is not just any cash value policy that you just pull off the shelf. Properly structured, optimally funded, high early cash value policy with a mutual company solving for the lowest death benefit, right? So when we talk about properly structured, we're not talking about a policy that you have to wait 5, 6, 7 years to have a cash value. We're talking about one properly structured so that for every dollar you have going in, upwards of 70 cents is going towards the cash value, which is the saving component of the policy, right? Optimally funded is based upon your cash flow, based upon your cash availability, right? So it's customized. The other piece, when we talk about high early cash value, you don't want to wait down the road for cash value. You want to get the highest early cash value you can get now. In order to do that, you're going to have different riders, you're going to have things called paid up additions and things of that nature, so that you can actually supercharge the pies. Without that, then you're going to have a policy that's kind of flat and not doing what you want it to do as far as acting like a bank or a secondary or even a primary savings bank, right? So you have to have those things in place. Also, you want to solve for the lowest death benefit. And I say this is the agent that you're working with, right? Here's the deal. When you solve for the lowest death benefit, that means less of your premium that goes into the policy is going towards the death benefit. Now, side note, what that means in real terms is that's a lower commission for the agent. A lot of agents don't like putting these type of policies together. Sorry for my fellow agents out there. They don't like putting this policy together because it doesn't pay them well, because if the majority of the money is going towards the cash value and not the death benefit, that's less of a commission paid out. And also too, it has to be with a mutual company. No, you can't do this at State Farm. No, you can't do this with the ones that are publicly traded. It needs to be with a company that is privately held and is mutual. Reason being, a mutual company, which is typically saying a company that is owned by the policy owners, receives a dividend. So what happens is as that company sees profitability, then the insurance company then issues a dividend to the owners of the company. If you have a policy with a mutual company, that means technically you're an owner. Just like if you receive a dividend from a stock, right? If you own a stock and receive a dividend, you didn't get interest, you got a dividend because you are a part owner of that company. That's what your dividend is. Same thing works for an insurance company. So that's why it has to be a mutual company for this to perform and do what you want it to do. So those are kind of the mechanics in short. And I would warn people who are listening. I warn you as you're listening to this. I've done some research, don't know how accurate it is, but the research I've done says less than 5% of licensed insurance agents know how to effectively create a infinite banking concept model policy. So no, you're not going to be able to go to your agent who does your property and casualty and say, hey, let me get one of them IBCs. Because again, IBC is not a policy. IBC is a strategy. Like anything else, a skill that has to be learned. And everybody's policy is different based upon your age, your sex, and your health, right? So again, you have to deal with a professional who specialize in these type of policies in order to get in order for it to perform the way you would like it to perform. Super easy, right? So you have money sitting inside this cash value policy. That cash value policy is getting some type of guaranteed return. Typically, the mutual companies issue a dividend for the year, saying, "Hey, for this year, everybody who has this policy is going to get this type of dividend." Okay, so now the money has a guaranteed, growth rate, if you will. When you go to access the money, you're not accessing the money by pulling it out. You don't want it. You want to keep the money inside the policy growing uninterrupted. How you want to access the money is via a policy loan. Now, I'm not going to get into the weeds of, a non-recognition or direct recognition loans. Just know that if properly structured, you should be able to get a policy loan without it impacting the growth of the policy, right? So when you get this policy loan, which can sometimes be as simple as a phone call, the property we just closed on today, I called into the insurance company, said, "Hey, send us the money." They sent us $15,000. We was able to send us a down payment to close on a property today. Or one of my other carriers, I can jump right online, request a loan. I don't need to produce a credit score. They don't care nothing about my debt to income ratio. They don't care nothing about my blood type, my mama's name, maiden name, nothing of that sort. Because if you think about it, why wouldn't they be okay with letting us get access to the money via a policy loan? The cash value is there to support it, and if you never make a payment on the loan, what happens is that when you die, instead of your family getting the full death benefit, they get the death benefit minus what you owed on the loan, principal and interest. So it's a safe transaction for the insurance company. And you use that safety, you use that peace of mind that the insurance company has with getting a policy loan to create the infinite banking concept. So you let your money continue to grow uninterrupted, so you make the money in your left-hand pocket. You can use the policy loan to go out and invest in assets to produce cash flow in your right-hand pocket. And the loan, you can pay back at your discretion on your own time. And if you never paid it back, instead of your family getting, say, $1 million death benefit, they'll get $1 million minus $100,000 you owe. So instead of getting $1 million, let's say they get $900,000, hypothetically speaking. That's how you access the bread, and that's how you get to the bag. Let's first define work optional. Work optional is not retirement. Retirement is actually an age, right? Work optional is the point in time that you can choose whether or not you want to exchange your time for income. You become work optional when your cash flow, and I want to make sure we're clear on this because I go back and forth with my students about this all the time. Income and cash flow are not the same, though they're used interchangeably. Income is what you receive for performing some type of duty or action. Cash flow is the money that floweth, hence cash flow, floweth from assets that you've acquired. Real estate, businesses, franchises, dividend stocks, cryptocurrency, whatever the case may be, right? So again, when your cash flow is more than your monthly expenses, that's the point where you become work optional, where you can choose, you know what, I'm not going to work this month or I'm not going to work this year. And I know that my bills are going to be paid, right? So where we want to think along those lines, in order to become work optional, you have to be an asset acquisition expert. Let me share this with you guys. Most people have heard of Warren Buffett, right? Heard of Warren Buffett? Perfect. And most people think of Warren Buffett as being the best stock picker of all time. What if I told you Warren Buffett's specialty was not picking stock? Because it's not. His specialization is identifying companies to take over. That's what he specializes in. He buys the company through the means of buying the stock, but he's not sitting up looking at charts. He's going in and looking at companies that have a great track record, have great leadership, have strong cash flow and profitabilities, and putting a deal together that gives him a preferred dividend, which means as soon as he acquires that stock and typically buys 51% of the company. So he's the owner of the company. But when he acquires that stock, he acquires that stock with a preferred dividend, which means regardless of what that stock is doing, it's providing him predictable cash flow. Warren Buffett isn't in the business of buying stocks. He's in the business of buying companies. He just buys them through stock. Again, what is wealth? A system of ownership that produces predictable cash flow. When you start to understand that, you start to realize that that's the cheat code. Acquire assets that give you cash flow. Great question. Who can run this play? The question is, who can't run this play? The play can be ran if you are intentional about becoming a work option. Because I remember, true story, it was right when I graduated from college, right? Wasn't making a lot of money, was making $30,000 a year as a school teacher. And I had a buddy of mine that I ran cross country with, Carlos. Big shout out to Los if you're ever watching this video 30 years after the fact. Correct. And I remember him linking up with me and being like, dude, you got to get this insurance. So I remember getting this insurance policy, and it was a whole life policy. Fast forward, I left home, took on another job, commission-based job, and income was tight, expenses was high. So I was looking at things to cut. Unfortunately, not knowing then what I know now, I stopped making payments on the policy. Hindsight being 2020, whether he knew it or not, he was setting me up to start to think like the bank. But because I had a consumer mindset and a scarcity mindset, I didn't realize that. And I was only making at the time $30,000 a year. And I believe in this particular policy, I think I was putting in maybe $100 a month. So this is not you gotta have $50,000 to dump in. If you do, man, you can run with this thing, right? But you can start this at a lower dollar amount based upon where you are today. And let this sink in. When you understand that infinite banking concept is a system, you can have policies on everyone in your family. Go research how the Rockefellers did. As soon as a kid was born, that kid don't have any income. So you can't tell me that newborn, you know what I'm saying, like, oh, behind the newborn was making $100,000, right? So you can put a policy on anyone that you have insurable interest on. So this is not do I have the money to do it? It is, do I have the intention and the desire to do it? And do I understand that becoming your own bank is true freedom? When you don't have to go beg and plead to get access to capital, when you can go to your own system and get access to capital for college, right? Let's not even talk about just the financial freedom piece. What if we financed our daughter's car with the infinite banking concept, right? We can pay for college, using this strategy. We can help them, invest in their first business with this strategy. And we can acquire assets with this strategy. Oh, let me not be remiss to mention this. What if you paid off your debt with this strategy? Hold on. Perry, what do you mean? You can pay off your debt and build wealth at the same damn time? Yes. What if you're using a strategy to store your money in a properly structured policy of this nature, then use the policy loan to pay off your debt with no required monthly payment? You now have paid off the debt, your credit score has shot up, you've reduced your monthly expenses, and you still have your money inside the policy still growing uninterrupted and still earning a dividend. This is not about I have to be wealthy or a high income earner to run the play. This, are you willing to learn how to run the play and put yourself, in a position that makes sense? Who is this strategy a perfect fit for? You got to have some positive cash flow, family, right? So this is not hey, I got to be a multi-67 figure income earner, right? You could be a $30, $40, $50,000 income earner, but you have to have cash flow. And let me rephrase that, not cash flow. You need to have discretionary income. If you don't have any money saved today and you have more expenses than you have income, you're not going to be able to run this play. You first have to fix that cash flow situation. If If your monthly expenses are 5,000 a month and your income's only four, that means that you're functioning at a $1,000 loss every month. You can't run this play, right? This is not, you know what I'm saying, we're not turning water into wine over here. You actually have to have some cash flow. And if you have not created a savings mindset where you at least have some money set aside to be able to fund the policy, then you're not going to be able to run this play. So who this play is not for is for the individual who spends more than what they make, and for the individual who does not already have a saving strategy in place. Who this is for the person who has discretionary income per month, and for the person who's already started saving and investing and has capital to work with. That's who this is for and who it's not for. But it's not based upon, oh, you got to be in a certain tax bracket to run this play, contrary to popular belief. If you want to learn how to do what we discussed today, the next step is to get smarter. I've given you the books to read. R. Nelson Nash, Become Your Own Banker. Gary Gunnarsson, What Would the Rockefellers Do? Gary Gunnarsson, Killing Sacred Cows. So you first need to get accustomed to the language. Then after you're accustomed to the language, what you also want to do is find a mentor or a coach who can actually help you navigate this. Again, this is not, hey, I got this policy, let me now have my own bank. No, this is a system. But this system is a disruptor because it is going against the actual grain that the financial system has told us what to do. The financial system has told us to save and wait, invest and wait, and that all debt is bad. And this system is totally different. This system is store and leverage, be okay with policy loans, and create cash flow today, right? So get accustomed to the language. Do your due diligence. Find somebody who's actually doing it, not somebody who's talking about doing it. Find somebody who can actually lift up the lid, lift up the hood, and show you their accounts. And then when you get that coaching, that mentorship, right, join the program. Like, shameless plug here, join our Think Like the Bank Challenge. We go through 5 days of walking individuals through exactly not just this system, but how the banking system is built, how the banking system makes money, and how the banking system engineers cash flow, so you can steal that strategy and put it into your own personal finances, right? So those are the next steps: is get smarter, get a mentor, get a coach, and then when you get a mentor and get a coach, guess what you're going to find out? Because a mentor is somebody who's a little bit further along than you, right? That means they already have a policy, which means they already know agents like ourselves who can actually write the policy for you, right? Get a coach who's using the policy like we are to buy real estate so that they can walk you through, hey, be careful of this, where this company is a little different than this company, or this carrier has different rules than this carrier, right? So you know, you already have somebody who can help you navigate that, right? That's how you win. Get smarter, get a mentor, get a coach. When you build your team, they already have access to the resources. They already have access to individuals who know how to build these types of strategies, right? And they can show you how to use it. That is your cheat code. Go steal somebody else's 10,000 hours of expertise. Go steal somebody else's homework so you don't have to figure this out on your own. But it first starts with you having a desire to grow your financial literacy. And literacy is just understanding words. And you can understand words by reading books and asking questions. So that's your next step. Man, thank you for taking the time to check this out, right? I hope this is not meant to solve the problem. It's meant to make you aware of the problem and also aware that there are other solutions and strategies out there than what you're hearing in mainstream, right? And that's my wish for you, is just to give you that heightened sense of awareness. What you do with that heightened sense of awareness, the next step that you take is going to be on you. Just know that we're here as a community to help you navigate. So whether you're coming into one of our paid programs or you're just joining our YouTube and watching our weekly cash flow show, we are here to help you unblock your cash flow, which in turn unlocks your freedom. That's it, y'all. Peace.